On May 29, 1968, Lyndon Johnson signed the Consumer Credit Protection Act into law, and the official record credits that signature with ending a specific kind of deception. Before that date, a lender could quote a borrower a rate of 6% and mean something entirely different from what 6% implies. After that date, every lender in the country was required to state the true annual percentage rate in the same place, in the same size type, calculated the same way. Historians of consumer policy generally treat this as the moment America caught up to a problem it had somehow failed to notice, that ordinary people borrowing money for a car, a refrigerator, or a hospital bill had no reliable way to know what the loan actually cost them. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. That account is accurate as far as it goes. It is also incomplete in a way that matters. The deception the Truth in Lending Act addressed was not hidden. It was licensed. For more than 50 years before 1968, the exact arithmetic that made borrowing costs look smaller than they were had been written into state law, defended by name in congressional testimony, and built into the balance sheets of some of the largest finance companies in the country. The people who understood the gap between the stated rate and the real one were not con artists working outside the system. They ran it. To understand how that gap became law, you have to go back before there was a licensed consumer finance industry at all, to a period when borrowing small sums of money meant dealing with what everyone at the time simply called the loan shark. In the years around the turn of the 20th century, a factory worker who needed $40 to cover a medical bill or a missed rent payment had almost nowhere legal to go. State usury laws, many of them dating to the colonial era, capped interest at rates like 6 or 8% a year, rates that made no economic sense for a lender extending unsecured credit to a stranger with no collateral and no credit history. Legitimate banks would not touch loans that small, so the market that formed to fill the gap operated almost entirely outside the law, charging borrowers 10, 15, sometimes 20% a month, enforced through wage assignments, threats of exposure to employers, and in the worst cases, physical intimidation. Investigators for charitable societies in New York and Chicago documented cases of workers paying more in interest over a year than they had originally borrowed, trapped in loans that renewed indefinitely because they could never pay down the principal. The response to that crisis did not come from Congress. It came from a private philanthropy. The Russell Sage Foundation, established in 1907, created a division of remedial loans specifically to study the small loan problem, and its director, Arthur Ham, concluded that prohibition had failed. Outlawing high rates had not stopped high-rate lending. It had simply pushed all of it underground, beyond the reach of any regulator. Ham's solution, drafted through the 1910s and formally published as the Uniform Small Loan Law in 1916, was to legalize a licensed alternative. States that adopted the model law permitted specially licensed lenders to charge rates far above the old usury ceilings, often in the range of 3 to 3.5% a month, in exchange for state supervision, mandatory licensing, and a ban on the collection tactics that had made the illegal loan shark trade so brutal. It was, by the standards of the time, a genuine reform. It was also the moment the modern consumer finance industry was born, with the state's blessing baked into its charter from the start. The companies that grew out of that legal opening became some of the largest financial institutions in the country within a generation. Household Finance Corporation, tracing its roots to a Minneapolis lender founded in 1878, expanded aggressively once state after state adopted the Uniform Small Loan Law, opening branch offices across the Midwest and then nationally. Beneficial Loan Society, founded in Wilmington, Delaware in 1914 by Clarence Hodson, built a similar network under the same legal framework, eventually becoming Beneficial Corporation, one of the largest consumer lenders in America for most of the 20th century. Commercial Credit Company, chartered in Baltimore in 1912, extended the same model into automobile and appliance financing. By the 1950s, these firms and dozens like them had trade associations, lobbying budgets, and a shared institutional interest in keeping the arithmetic of their loans exactly as opaque as the law allowed. That arithmetic is the center of the record the Truth in Lending Act eventually forced into the open. The method most small loan and installment lenders used to calculate interest was called add-on interest, and it worked like this. A lender computing the cost of a $500 loan over 2 years at a stated rate of 6% would calculate that 6% against the full $500 for the full 2 years, producing $60 in interest. Then add that $60 to the principal and divide the total into equal monthly payments. It sounded like a 6% loan. It was not. Because the borrower was paying down the principal every month, they never actually had the use of the full $500 for the full 2 years. By the second year, they might owe only $200 in principal, while still paying interest calculated as though they owed the original $500. Run the true math, the annual percentage rate on the declining balance the borrower actually carried, and that 6% add-on loan worked out to something closer to 11 or 12%. On loans quoted at higher add-on rates, the true annual percentage rate could run to 20% or more than double the number printed on the loan agreement. Retail installment sellers used a parallel version of the same trick. When a family bought a refrigerator, a sofa, or a used car on installment terms from a department store or a dealer, the financing was typically arranged not by the store itself, but by a captive finance arm built for exactly that purpose. General Motors Acceptance Corporation, formed in 1919, financed the purchase of General Motors vehicles nationwide using discount and add-on methods that produced the same understatement of true cost. Sears, Roebuck and Company ran its own acceptance corporation for the same reason. These companies also relied on a technique called the Rule of 78, a method of allocating interest across the life of a loan that front-loaded the interest into the earliest payments. A borrower who paid off a loan early, thinking they would save on interest, often discovered that the lender had already collected the overwhelming majority of the interest due over the full term, leaving almost nothing to rebate. The Rule of 78 was not fraud under the law of the states that permitted it. It was standard practice, taught in finance company training manuals and defended in state legislative hearings as a reasonable way to compensate a lender for the risk of early payoff. Enforcement against borrowers who fell behind was its own institutionalized system. Many installment contracts included a confession of judgment clause, in which the borrower signed away, in advance, their right to contest a lawsuit if they missed payments, allowing a lender to obtain a default judgment without the borrower ever appearing in court. Wage assignment clauses let a lender go directly to a borrower's employer and garnish part of their paycheck the moment a payment was missed, a practice that put pressure not just on the borrower, but on their standing at work. These tools fell hardest on the borrowers with the least bargaining power. Low-income households and disproportionately black borrowers in cities where redlining had already cut them off from conventional bank credit relied most heavily on small loan and installment financing and were the ones most exposed to the compounding effect of add-on interest, Rule of 78 allocation, and wage garnishment working together. Against that backdrop, the industry that had been built on the Uniform Small Loan Law's legal foundation had every reason to defend the add-on method when reformers finally came for it. Senator Paul Douglas of Illinois, an economist by training before he entered the Senate, introduced the first version of what he called the Truth in Lending Bill in 1960, requiring lenders to disclose the true annual percentage rate on every consumer loan, rather than a rate calculated by whatever method the lender preferred. The National Consumer Finance Association, the trade group representing the licensed small loan industry that had grown up under Arthur Ham's model law, testified against the bill in hearing after hearing, arguing that the add-on rate was simpler for ordinary borrowers to understand than a compounding annual percentage figure, and that mandatory uniform disclosure would be confusing rather than clarifying. Retail trade groups representing department stores and auto dealers made a similar case. Douglas reintroduced his bill in 1961, again in 1963, again in 1965. Each time it stalled in committee or died without a floor vote, worn down by an industry that had spent 5 decades building the very legal architecture the bill was designed to dismantle. Douglas lost his Senate seat in the 1966 election, and for a moment, it looked as though the truth in lending fight might die with his defeat. Instead, the effort passed to Senator William Proxmire of Wisconsin, who chaired the Senate Banking and Currency Committee's Consumer Credit Subcommittee and pushed the bill through a fresh round of hearings in 1966 and 1967. Those hearings produced the evidentiary core of the case against add-on interest, because for the first time, witnesses were asked to convert real loan contracts, the actual paperwork issued by real finance companies and retailers, into true annual percentage rates using a consistent formula. The results were damning in a way that abstract argument had never managed to be. Loans quoted at what sounded like modest rates of 6 or 8% add-on translated to true costs in the range of 11 to 14%. Some retail installment contracts, layering add-on interest with additional fees for credit insurance that borrowers had often not meaningfully chosen, produced effective annual rates that ran well above 20%, and in isolated cases involving door-to-door sales financing and used automobile lending, effective rates were shown to exceed 100% once every fee and charge was accounted for. Proxmire's committee also heard testimony connecting the credit insurance add-ons, sold alongside nearly every installment loan and often bundled into the financed amount without a separate clear price, directly back to the same finance companies that had built their business on the 1916 model law, since credit insurance commissions had become a significant and largely invisible source of their profit. President Lyndon Johnson's administration, building consumer protection into the broader architecture of the Great Society, backed Proxmire's push, and Betty Furness, whom Johnson had appointed as his special assistant for consumer affairs in 1967, used the position to keep public pressure on Congress through the final year of debate. The bill that finally passed in 1968 folded into the broader Consumer Credit Protection Act as Title I, the Truth in Lending Act, did exactly what its name promised, and nothing more. It required lenders to disclose the annual percentage rate and the total finance charge, calculated by a uniform federal formula, in a clear format before a loan was signed. It did not cap interest rates. It did not eliminate add-on calculation as a way of setting the price of credit, only as a way of describing it. It did not touch wage assignment or confession of judgment clauses, which continued to be regulated, unevenly and often not at all, at the state level. The Federal Reserve was assigned to write the implementing rule, published as Regulation Z, and taking effect in July of 1969, and enforcement of that rule fell to an alphabet of federal agencies with jurisdiction, split by the type of lender involved, a fragmented structure that would itself become a recurring complaint in the decades that followed. The gap between disclosure and protection surfaced almost immediately. The National Commission on Consumer Finance, created by Congress in the same legislation to study the broader state of consumer credit, published its findings in 1972 and documented a financial system that had adjusted to the new disclosure requirement without meaningfully changing its underlying economics. Add-on and discount rate loans still existed, now simply relabeled with an accurate annual percentage rate printed alongside them. A number many borrowers, the Commission found, still did not fully understand or use in comparing offers. Historian Lyndon Calder, whose later research traced the full arc of American consumer credit from the 19th century small loan crisis through the post-war installment economy, would describe the 1968 Act as a victory of transparency built directly on top of a pricing structure that transparency alone was never designed to fix. The law told borrowers the truth about what they were paying. It did nothing to lower what they were paying or to stop new mechanisms for extracting the same margins from emerging. Those new mechanisms arrived within a decade, not from the consumer finance companies that had shaped the 1916 and 1968 fights, but from the banking industry, and through a legal channel that had nothing directly to do with truth in lending at all. In 1978, the Supreme Court decided Marquette National Bank of Minneapolis versus First of Omaha Service Corporation, ruling that a nationally chartered bank could charge the interest rate permitted in the state where it was headquartered, even when lending to a customer in a state with a much lower usury ceiling. The ruling effectively meant that a bank could choose its home state for the sole purpose of choosing its interest rate. 2 years later, Congress passed the Depository Institutions Deregulation and Monetary Control Act of 1980, which preempted many remaining state usury caps on the kinds of loans covered by federal deposit insurance, further widening the same door. South Dakota's Governor Bill Janklow saw the opening and in 1981 pushed a bill through his state legislature eliminating South Dakota's usury ceiling entirely, in a deliberate bid to attract bank charters. Citibank moved its credit card operations to Sioux Falls that same year. Other card issuers followed the same path to South Dakota and Delaware, which passed similar deregulation shortly after. The credit card industry that Americans use today, headquartered overwhelmingly in a small number of states chosen specifically for the absence of a rate ceiling, is a direct institutional descendant of the Marquette decision and the legislative response to it, a mechanism built almost exactly a decade after Truth in Lending had supposedly settled the question of how consumer credit would be priced and disclosed in America. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. Payday lending as a distinct industry grew out of an older business, the check cashing store. Once new state laws in the 1990s began carving out specific exemptions from small loan and usury statutes for short-term loans secured by a post-dated check. Check into Cash, founded in Cleveland, Tennessee in 1993, and Advance America, founded in South Carolina in 1997, grew within a few years into national chains with thousands of storefronts, most of them in low-income neighborhoods that conventional banks had long since stopped serving with branches of their own. The loans were short, typically due in full at the borrower's next payday, and the fee was quoted the way the industry preferred it quoted, as a flat charge of $15 or $20 per $100 borrowed, rather than as an annual rate. Convert that fee into the annual percentage rate Truth in Lending required lenders to disclose, and a $15 fee on a 2-week loan worked out to an annual rate near 400%, a figure that was in fact disclosed, printed exactly where federal law said it had to be printed, and largely ignored by borrowers who needed the money that week and had no realistic alternative. Congress eventually intervened for one narrow population. The Military Lending Act of 2006 capped the rate lenders could charge active duty service members and their families at 36%, an acknowledgement, embedded directly in the statute, that the open market rate the rest of the country lived with was considered too predatory to impose on soldiers. The Consumer Financial Protection Bureau attempted a broader rule in 2017, requiring payday lenders to assess a borrower's ability to repay before extending a loan, a standard that had existed for mortgages since the aftermath of the financial crisis, but had never applied to short-term small-dollar lending. The rule's core underwriting requirement was rescinded in 2020 before it fully took effect, following heavy lobbying from the trade association, by then renamed the Community Financial Services Association, that had once fought Paul Douglas over add-on interest under a different name. The subprime mortgage boom of the early 2000s ran the same play at a scale the small loan industry of 1916 could not have imagined. Lenders like Countrywide Financial, built into the largest mortgage originator in the country, under Chief Executive Angelo Mozillo, issued adjustable-rate loans with a low introductory rate that reset, often after 2 years, to a much higher rate calculated against a market index, a structure disclosed under the Truth in Lending Act's rules but disclosed in a format, and often at a stage in the transaction, that gave borrowers little practical ability to compare it against alternatives before they had already committed to the purchase and the closing date. Many of these loans also carried prepayment penalties, a fee charged to a borrower who tried to refinance out of the loan before a set number of years had passed, which meant that a borrower who realized the reset rate was unaffordable often could not escape it without paying a separate penalty to leave. Mortgage brokers were frequently paid yield spread premiums, a payment from the lender that increased the broker's compensation for placing a borrower into a loan with a higher rate than the borrower actually qualified for, a payment structure that operated entirely within the broker-lender relationship and appeared nowhere on the Truth in Lending statement the borrower received. The Home Ownership and Equity Protection Act of 1994 had already tried to address high-cost mortgage lending, amending the original 1968 statute with additional disclosure and restrictions once a loan crossed certain rate and fee thresholds. But those thresholds were set high enough that the bulk of the subprime market that expanded through the 2000s never triggered them at all. Congress responded to the resulting collapse with 2 pieces of legislation that, together, show exactly how far the country was willing to go and exactly where it continued to stop. The Credit Card Accountability, Responsibility, and Disclosure Act of 2009 banned card issuers from raising the interest rate on an existing balance without advance notice, restricted marketing credit to college students under 21 without a cosigner or proof of income, and required issuers to obtain a customer's explicit consent before enrolling them in overdraft-style over-limit fee programs. Each of these was a real and specific constraint on a real and specific practice. None of them touched the rate a card issuer was permitted to charge in the first place, the question the Marquette decision and South Dakota's repeal of its own usury ceiling had already settled 3 decades earlier. The following year, the Dodd-Frank Wall Street Reform and Consumer Protection Act created the Consumer Financial Protection Bureau, an idea Elizabeth Warren had first laid out in a 2007 Law Review article proposing a single federal agency modeled loosely on product safety regulation, arguing that a toaster sold in America had to meet more federal safety standards than a mortgage did. Richard Cordray became the Bureau's first confirmed director in 2012, inheriting enforcement authority over the Truth in Lending Act that had been split since Regulation Z first took effect in 1969, across the Federal Reserve, the Federal Trade Commission, and several banking regulators with overlapping and often contradictory jurisdiction. In 2015, the Bureau merged the separate disclosure forms required under the Truth in Lending Act and the decades-older Real Estate Settlement Procedures Act into a single mortgage disclosure package, the loan estimate and the closing disclosure, a consolidation that addressed a confusion problem nearly as old as the original 1968 statute itself, since borrowers had spent almost half a century receiving 2 federally mandated but differently formatted documents describing the same loan. The newest version of the same gap does not involve a licensed finance company, a bank, or a mortgage broker at all. Buy now, pay later services, built by companies founded well after the financial crisis, let a shopper split a purchase into several fixed installments, often 4 payments spaced 2 weeks apart, charging no interest on the standard plan. Because these products are frequently structured to avoid meeting the technical definition of credit that triggers Truth in Lending Act disclosure, a definition built around finance charges and a threshold number of installments that predates online retail by half a century, many of them are not required to disclose an annual percentage rate at all, even though a late fee on a missed installment, expressed as an annualized rate on the remaining balance, would look very much like the add-on rates finance companies were quoting borrowers before 1968. The Consumer Financial Protection Bureau opened an inquiry into the industry's disclosure practices, examining whether products marketed as a modern, interest-free alternative to a credit card had, in practice, recreated a version of the exact disclosure gap the country first tried to close more than half a century earlier. The credit card industry itself grew out of the same 1968 settlement in a way that is easy to miss, because it looks like ordinary product history rather than financial history. Bank of America had introduced the Bank AmeriCard in 1958, and a group of competing banks organized MasterCharge in 1966, both extending revolving credit to a mass market for the first time, using variations on the same add-on and periodic rate methods regulators would spend years arguing over. Bank AmeriCard became Visa in 1976, and MasterCharge became MasterCard in 1979, and the two card networks, rather than any single originating bank, became the institutional structure that outlasted the deregulation fights of the following decade. When the Marquette decision and South Dakota's repealed usury ceiling let issuers relocate their card operations to whichever state offered the least restriction, it was the Visa and MasterCard networks, not any bank's regional footprint, that let millions of newly unregulated interest rates reach cardholders in every state at once, regardless of what that cardholder's own state legislature had ever voted to permit. The oldest version of the mechanism, meanwhile, never went away. Rent-to-own retailers, selling furniture, appliances, and electronics through a rental agreement structured to end in ownership after a fixed number of payments, are regulated in most states not as lenders at all, but as a form of consumer rental, exempt from Truth in Lending Act disclosure because no loan, in the technical legal sense, is ever made. A rent-to-own contract for a refrigerator can cost a customer 2 or 3 times the retail price of the same appliance by the time the final payment clears, an effective financing cost that would read as a triple-digit annual percentage rate if it were priced as a loan rather than structured as a lease, and it is not, so it is not disclosed as one. A similar exemption covers much of the buy here, pay here used car lot business, which finances vehicles directly to buyers with poor or no credit history, retains the title until the loan is paid, and repossesses the car, often within days of a missed payment, to resell to the next buyer on the same terms. A single vehicle can pass through that cycle many times over its working life, generating a fresh round of financing income with each repossession, without the dealer's actual inventory ever needing to grow. The industry adapted to state-level bans the same way it had adapted to the 1968 disclosure requirement, by changing the label on the product rather than the arithmetic underneath it. In states that banned payday lending outright, several of the largest chains began marketing longer-term installment loans instead, structured over months rather than weeks and priced, once again, in a way that produced an effective annual percentage rate in the triple digits while complying with whatever installment lending statute the state had left in place. Consumer finance companies operating today under names like OneMain Financial trace their corporate lineage, through decades of mergers and rebranding, back to licensed small loan chains chartered in the years immediately after Arthur Ham's model law passed state legislatures across the country. The same chains that built the industry Paul Douglas spent most of a decade trying to force into the open. Ohio offers one of the clearest examples of how durable that adaptability has been. Voters there approved a ballot measure in 2008 capping short-term loan rates at 28%, a direct, popular rejection of the payday lending model. Lenders responded by reincorporating under the state's Mortgage Lending and Credit Services Organization statutes, laws written for entirely different purposes, and continued issuing loans that functioned exactly like the ones voters had just banned, now priced through broker fees and credit access charges layered on top of the loan rather than folded into a single quoted interest rate. It took the Ohio legislature until 2018 to close that particular reclassification loophole, a full decade after the vote that was supposed to have already settled the question. Medical debt occupies a similar blind spot. The rule written to enforce the 1968 Act exempts any payment plan of 4 installments or fewer that carries no separate finance charge, an exemption drafted for a corner grocer letting a regular customer settle a bill over a few weeks, not for a hospital converting an emergency room visit into a payment plan. Many providers structure their payment arrangements to fit precisely inside that exemption, avoiding any truth in lending disclosure at all, while medical credit cards marketed in the same billing office, carrying deferred interest promotional periods that convert to rates above 25% if the balance is not paid in full by a fixed date, do fall under the Act and must disclose their rate. Almost no patient signing paperwork at a hospital counter has any practical way to notice that distinction or to act on it in the moment it is being asked of them. Members of Congress have introduced a federal interest rate cap modeled on the 36% ceiling the Military Lending Act already applies to service members, extending it to the general public in nearly every session since the financial crisis, and none of those bills has passed. The consumer finance industry that opposes them today is not, in any strict legal sense, the same industry the National Consumer Finance Association represented when it fought Paul Douglas over add-on interest in 1960. It is the direct descendant of it, operating under different names and selling different products, using the same argument its predecessors used in 1960, 1963, and 1965, that a rate ceiling would cut off legitimate credit to the borrowers who need it most, and that disclosure, not restriction, is the appropriate role for federal law. That argument won in 1968 in the narrow sense that it kept a price ceiling out of the bill that finally passed. It has been winning the same argument, largely unchanged, in every decade since. Return to where the record began: a hospital billing counter, a payday storefront, a rent-to-own showroom, a mortgage closing table, and the shape of the pattern holds each time. A disclosure obligation exists, is satisfied on paper, and sits beside a price that regulation never touched. That is not a failure of enforcement. It is the system working exactly as it was designed to work in 1916, when Arthur Ham first decided that the honest path forward was to license high-cost lending rather than outlaw it, and again in 1968, when Paul Douglas and William Proxmire finally won the fight to make that price visible without ever winning the separate fight to make it smaller. None of these later reforms reopened the original question the 1968 Act had chosen not to answer: whether the federal government should limit how much a lender is allowed to charge, as opposed to simply requiring that the charge be stated accurately. That choice, made under pressure from an industry whose entire modern form had been built on a 1916 model law designed to legalize, license, and regulate high-cost lending rather than eliminate it, has held for more than half a century across a Supreme Court ruling, a federal preemption statute, a state legislature's rewrite of its own usury code, and successive waves of new lending built each time to operate inside whatever the last reform left open. The 1968 Act is remembered as the year America stopped predatory lending. The ledger shows something narrower and more durable, that it was instead the year America agreed to be told the truth about a system it had already decided, more than 50 years earlier, not to actually restrain. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.